Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, March 15th, 4:55 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we are in an uptrend, a volatile, or uptrend, yeah, correction, a volatile correction with strain on the financial system that is really putting bulls and bears to the test. The reason for that is when you're in a bearish market, uh, there's a saying on Wall Street that bull markets wear out the bears, but bull markets wear out the bears, but bear markets wear out bulls and bears because the bears get worn out by the violent rallies that happen during short covering, and the bulls get worn out waiting for the uptrend that never comes. And that's kind of what we've seen since the uncertainty was added, as if the market didn't have enough stuff to worry about between inflation, the war, uh, the Fed, interest rates, uh, possible looming recession. Let's throw in a banking crisis, and that hit the market starting last Wednesday, Thursday, continued into Friday. A 1 day reprieve until overnight Tuesday into Wednesday. European banks uh, came under some stress, starting with Credit Suisse, ticker CS, has been really weak for a long time, and one of its big backers, Saudi Arabia, came out and said, "Yeah, we're not going to help you anymore," and that led to a sell-off in European banks that carried over to the indexes, that carried over to the U.S. with a big gap down, and we did recover some in the afternoon. NASDAQ 100 stayed extremely strong, so we've got that as a port in the storm, and that is a place where portfolio managers can park millions, tens of millions, hundreds of millions of dollars into those big NASDAQ type stocks. So that's what we're seeing right now. Let's go over here to the trend gauge. Market leaders still holding up okay, got them neutral with a red sub arrow. Short term, all five of the major indexes that we discuss in these videos are trending below. I should say four of them are trending below their short-term 21-day moving average. The NASDAQ 100 actually above. I've been doing these videos for a long time. I don't remember another situation where the NASDAQ was completely above the three main moving averages, timeframes that we track, and every other index was below. Same thing with the 50-day, all four of them below the 50-day moving average. Not all four of the five, the NASDAQ above the 200-day moving average, four of the five below, the NASDAQ 100 above. So very clearly a mixed bag. Financials continue to be weak. Add into that industrials, basic materials, and oils, and you've got a massive bifurcated market. Staples held up okay today, utilities also, and real estate, as interest rates came off again due to massive money flowing into the bond market. Demand for bonds up means the price of the bonds goes up, means the yield on the bonds goes lower. So what happened today, as I mentioned, gap down on European banks. NASDAQ 100 stays strong. Here are the numbers on the day. G6, this is our 6 ETF. Growth composite, 5 of the 6 down. ARK-K staying strong. Kathy Woods staying strong. But the net composite down 1.6%. S&P 500 gap down 1.3%, was down over 2% pre-market. Closed that in the afternoon to being down 0.7%. NASDAQ 100 positive by 0.5%. Dow Jones Industrial Average down 0.9%. Mid caps down 2.2. Russell down 1.7. Again, this is where the banks, smaller banks, regional banks, mid caps, and small caps, that's where a bunch of them reside. And then, as I said, add in oils to that today. And the basic materials and metals. Global diversified 60/40 down 0.47%. That's with bonds being very green. In-house GROTECTION, we were positive today, 0.14%. We'll talk about the portfolio changes and where we stand going into tomorrow when we get to the tail of the tape. Let's get right into it. Let's start off with, as always, a chart of the S&P 500. And why do we get defensive at times? Because we're trying to avoid these. All bear markets occur under this black line on the S&P 500 chart. That's the 200-day moving average. And after breaking back above it earlier this year, we stayed above, but broke back below it, put in a big head and shoulders pattern on the S&P 500, broke below it last week with the banking crisis, ran into the moving average Tuesday, couldn't get above it, gap down this morning, did finish at the highs of the day. But this is, let's call this the second strongest of the 5 indexes, and with it being below all the moving averages, that says something about how bad the other indexes are. But anyway, all bear markets occur under the 200-day moving average. Our number one concern at Revere isn't to stick you in a pie chart and tell you to think long term. It's to prevent a massive uh, negative sequence of returns to hit your portfolio as you approach retirement that you may not have time to recover from. So if you're interested in this approach, reach out to me, Don Vandenbord at revereasset.com, or call 855 Real Wealth. That's 855-732-5932. Simply put, we participate in uptrends, get out of the way during downtrends. There's a lot of shades of gray in between, and we've got varying levels of exposure to the markets depending on what's working and avoiding what's not. So let's go to a 5-minute chart here on the S&P. You can see the big gap down, choppy all morning, uh, down this 38.38 low, not quite as bad as the big gap down on Monday, which we quickly recovered from. But as long as we're above that 3,800, I'm not going to get overly bearish, because if you look at the daily chart, we've basically been in a big 10-month range of about 20%. And we're closer to the bottom of that range and under the 200-day moving average, and under all of the under the medium term and the short term trend indicators. So obviously it's not a healthy situation, but there are pockets of strength. And that pocket of strength right now is the NASDAQ. So you can see how we chopped around and then tried to break higher in the afternoon above this 38.75, which was kind of a key level all day. That was the low yesterday. The highs of the morning, we broke above it, and then it held the lows most of the afternoon before an undercut and reclaim into the close. So 38.75, a big level today. Let's see if it plays a role tomorrow. We closed at 38.92. So back to, let's go to a 60-minute chart for some more context, and you can see that this big range here, really what we need to get back above is this 39.40-ish level, and that just so happens to correspond to this black line on the chart, the 200-day moving average. So let's get back above there. Bulls certainly want to see that. We've got the declining 21 coming into play close to the 200. That should happen later this week or early next week. So there's the S&P 500. How about let's put a happy face on things and talk about the NASDAQ 100 now. We cut below the 21-day intraday, actually an outside positive reversal, meaning we made a lower low and we made a higher high intraday. Let's look at a 60-minute chart here. Much more attractive chart than what I just showed you with the S&P. We can go to the 5-minute, and you can see not the gap down to the situation that we looked at yesterday. Let's compare those again real close. There's the NASDAQ 100. There's the S&P 500. A world of difference between the way they're acting right now. And really primarily the FANG stocks, as yesterday semiconductors were strong. Today semiconductors were down 1.2%. Overall, pockets of strength within semiconductors. I still consider them to be the leading sector. But again, you can see the chop, and then we broke out after 2:25 p.m. today, made higher highs versus yesterday, and actually closed above yesterday's high in positive territory by 0.5%. NASDAQ 100 very clearly an area of strength. above all the moving averages, forming what looks like a nice stage one flat base here, only 9% deep. Stochastic favorable also. Let's go to the Dow. Dow made a lower low, but undercut and reclaimed that recent low of Monday today. So a little bit of a positive there, but still doesn't look very enticing with it being below the 200-day moving average. Let's go to mid caps. MDY tried to get above the 200-day yesterday, failed into the close, made a lower low, but again closed above that lower low from Monday. So a little bit of a positive there. Anytime you can close off the lows, it also gives you a reference point for stops for positions that you're taking. So you're seeing a lot of these look like hammers. Undercut here also on below Monday's lows on the small caps. You can see this 170 area, a big area of support going back to December. Undercut that, closed back above it. Very oversold on in this situation too on mid caps. Let's check the stochastics real quickly. Very oversold on small caps, also on mid caps, on the Dow. Oversold also. So those are the major indexes. We're not really QQEW. Everybody was saying, man, you don't want to do index investing. You need to go with these equal weight ETFs. Well, these equal weight ETFs are getting their comeuppance after having shown some relative strength late last year, but finished negative on the day on the equal weighted Nasdaq 100, down 0.4%. Um, Not doing anybody any favors right now because that's where the money's flowing, is into the big cap Nasdaq 100 stocks and semiconductors, and the equal weight S&P 500 down 1.4%, significantly worse than the S&P 500. And note the relative weakness on this baby over the last week and a half. Um, there is no holy grail in investing, and when if you got some relative strength late last year out of being an equal weight S&P 500 and telling all your friends about it, make sure you tell them about how you're getting your ass kicked now because you're in the equal weight S&P 500, and it's taken a beating because of financials and what's going on in the market. RSP. So what's next? How about the dollar? UUP. Uh, Bullish today, gap up dollar. Not good for stocks, but the dollar is being looked at as an afterthought right now. It'll come back into the fore again, but right now the market has bigger fish to fry with the banks. Certainly, the stronger dollar doesn't help. And anytime there's a crisis, you typically see money flow into the U.S. dollar as a safe haven. If that continues, this will break above these recent highs on the 200-day moving average, and that's going to be a lag, a headwind on the U.S. markets. How about the VIX? Again, well off the highs, closing at the lows, just like the index is closed off the highs, but running into this 30 level again, and coming off the lows, but above 25, above all the moving averages. It means very clearly that risk is elevated right now. Let's flip to bonds now. Let's start off with the broad bond index, BND, up 1%. Look at this relative a higher high actually than Monday's close on the broad bond market. Money flowing very much into bonds, which means yields are coming down. Let's go to TLT, the 30-year, down or up 2%. Higher high also. Junk bonds down, which you expect when a soft market usually means soft junk bonds, which means the yields on these, they're having to pay up for you to buy them as the price goes lower. And corporate bonds, LQD, also up. These are what you consider the AAA rated investment grade, coming into a bunch of moving averages, also a higher close versus Monday. So let's go to the 10-year now. 0TNX down 4%, lower close versus Monday. This is again the panic of money flowing into bonds, which lowers the rates. The rates aren't going lower because the Fed wants them to, or because of anything really economic that's going on. We'll see what the Fed says next Wednesday. Boy, this is probably the biggest decision of Jay Powell's life with all the indecision going on. And let's go to the 30-year TYX, down 2%, so not a lower close uh, versus Monday's close for the 10-year. Let's look at the 5-year. A little bit shorter term, definitely lower closes. The shorter the duration, that's really what got pumped up, and that's where the yield is going lower significantly during this at least the last 4 days of this banking crisis. Let's go to precious metals. Gold made a higher high, well closed well off the highs. However, GDX gold stocks finished flat, ran into the 50-day moving average. Three tight closes now for these. Let's go to silver SLV. Up 0.55%, again finishing off the highs. And finally, Bitcoin, which has been a safe haven, down 3% today, giving back some of the gains of the last 2 days. And those are the major charts that we show at the beginning of every video. Now let's go to the tail of the tape. So freeze here if you want to read through the entire thing. The main thing I want to talk about is before the market, PPI came in and it was actually weaker than expectations. Under normal circumstance, this would have given stocks a pop, and it actually did for maybe 5 minutes before we started selling off lower because of what was going on with the European banks and the Saudis saying they had no intention of helping Credit Suisse. So weak PPI, this is something that Jerome Powell certainly wants to see. Maybe it'll give him an excuse not to raise. The odds now, as of right now, no raise 45%, 25 basis points, 55%. Massive change over the last week. Day count from up one to down one, 7 days now trending under the 80 EMA and the 21 EMA for the S&P 500. Expectations still negative with this being below the 200-day. However, we are holding this 3,800 level, which is key. We did break below the 3,900 on the S&P. Undercut and reclaim this 21 support resistance area with a nice close on the NASDAQ 100. So tight action today, breakout, held the breakout and just basing tightly into the close. So all in all, a decent finish of what was a much worse day when the day started. We'll see what tomorrow brings us. Positive today, gold and silver, XLC, PU, and R. So that's communications with Meta doing well and Google doing well. Staples and utilities, defensive sectors, tech, positive, but not by much. Real estate positive, by not by much. The big beat down was in yields and oils, basic materials, financials, industrials, PIC, which is base metal miners, and semiconductors also lagged today. Here's our focus list. We'll show some charts here momentarily. We got stopped on First Solar on some late morning, early afternoon weakness on it. We sold our SDS, which was our hedge, booked some decent gains on that. That raised our portfolio exposure from 0.17 to 0.27 going into tomorrow. Again, with the positive finish that we had here was a combination of booking gains when we got down into oversold levels periodically throughout the day, and the benefit from our QLD position. We also, as I said, we got stopped on First Solar. ANET also finished positive. Palo Alto down just a bit, bounced at its 21. TMDX down 1.5%, hanging around its 21. Semiconductors were weak, but bounced at the 50-day moving average. So the bottom line for today, gap down on the European bank fears, but afternoon strength and the NASDAQ 100 continues to stay strong. So let's see what tomorrow brings. Move on to some charts, and First Solar still looks good, but with our recent ad yesterday, which the losses from that ad yesterday offset the gains from some of our earlier buys. We got near positive, or sorry, near flat on the cumulative buys, so we exited on that. We'll wait for some a better market. It very clearly is still a leader, still above the 21, but you don't just sit there and wait for things to get down to the 21 and lose all of your gains. Let's take a look at ANET, one of the strongest stocks in the market, making a higher high. Look at the relative strength line on that. It's a thing of beauty. Now, some stocks that we don't own but are high on our watch list. AMD breaking out of a flat base off of its earnings gap. This looks fantastic. Look at the relative strength, making new high, confirming the price, and it's a stage one base. So market rights itself. Expect AMD to get some Revere cash, as well as NVIDIA closing up at the highs of this tight area that it's making. Let's call it a shelf, since it's gap up on earnings. Again, semiconductors overall the place to be. Also, Meta continues to act great. Back to the top of its base since its earnings. This is another stage one base, big liquid name. I like those at the large funds. Microsoft, 3 positive days. Look at that relative strength line. Again, this is where the money is flowing off of all the moving averages. CRM had a nice gap up on earnings, pulled back, bounced at the 21. 3 positive closes over the last 3 days. Again, this is where the money's flowing. ELF, one close below the 21, last 2 closes back above the 21, coming off of oversold. Still a leader, just in this tight area. The market certainly holding it down. Lennar reported after hours yesterday, was initially up and gapped up this morning, but the market got a hold of it, closed down slightly, but it's holding the 50 and the 21. And Schwab, which is our primary custodian, the fear around this seems to have been quelled for now. I'm going to set an alert below. It should not break below yesterday's low after the CEO coming out and buying 50,000 shares on the open market, and them talking about how their liquidity is not an issue in any way, shape, or form. So we'll see if that stands. And with that, I am going to wrap it up. So remember, it's not how much you make in the market, it's how much you can keep. We are in the current market condition is this mild correction off of the highs. We're right around 8%. So keep an eye on where the money continues to flow, and certainly what's going on with that bank sector. And it'll all come to a head next Wednesday with the FOMC meeting decision, and more importantly, the reaction off of that decision. So with that, I'm going to wrap it. Again, feedback, Don at revereasset.com, 855-REAL-WEALTH, 855-732-5932. So finishing up Wednesday, March 15th, this is Don Vandenbord telling it like it is. Just the market facts here at Revere. Thanks for listening, and we'll see you tomorrow.